Few forces move the currency market as fast or as decisively as a decision from the United States Federal Reserve. When the Fed acts, or even hints at acting, traders around the world respond within seconds. Understanding why that happens is one of the most practical things a Forex trader can learn. The Federal Reserve is the central bank of the United States. Its core job is to keep inflation under control and support maximum employment. Its main tool for doing that is the federal funds rate, the interest rate at which banks lend money to each other overnight. That single number has an outsized effect on the dollar, and through the dollar, on virtually every major currency pair. Here is the basic mechanism. When the Fed raises rates, dollar-denominated assets like U.S. Treasury bonds offer higher returns. Global investors want those returns, so they buy dollars to access them. More demand for dollars pushes the dollar higher. When the Fed cuts rates, the opposite happens. Returns fall, capital flows elsewhere, and the dollar tends to weaken. This relationship between interest rates and currency value forms the backbone of a huge portion of Forex analysis. What makes this more complex and more interesting is that markets are forward-looking. By the time the Fed actually moves rates, traders have usually already priced in the decision based on their expectations. A rate hike that everyone expected may cause almost no movement. An unexpected hold or an unexpected cut can trigger sharp swings across every major pair. This is why watching Fed communication matters just as much as watching the decisions themselves. The Fed communicates through FOMC meeting statements. The Fed chairs press conferences and speeches from individual officials. Even a subtle word change in an official statement can shift the market. Traders also watch key economic data closely: the Consumer Price Index for inflation, the monthly non-farm payrolls report for employment, because those numbers shape what the Fed is likely to do next. Beyond interest rates, the Fed also manages its balance sheet. Quantitative easing, where the Fed buys bonds to inject money into the system, tends to weaken the dollar over time. Quantitative tightening, the reverse process, can support dollar strength. Both matter to Forex traders. One more thing worth knowing, it is not just about U.S. rates in isolation. The dollar strengthens when U.S. rates rise relative to rates in other economies. If the European Central Bank is also raising rates, the effect on a pair like EUR/USD will likely be smaller than if the ECB is holding steady. Trading around Fed events carries real risk. Spreads widen, volatility spikes, and moves can reverse quickly. Before any FOMC meeting, know what the market is already expecting, because the gap between expectations and the actual decision is usually where the real move lives.